Evening and welcome to another FinEd session, the first FinEd session of 2024. I appreciate you all being here. And just to give you a bit of introduction, my name is Brian Nicol. I'm a certified financial planner and I own and manage a financial planning firm called Freedom Financial Planning. As always, this is a purely educational webinar. So this session is about, as you can see on the screen here, it's about life annuities and then how to maybe combine them with living annuities as well. Now, late last year, I did a presentation on living annuities. And so if you have not seen that yet, I'm not going to touch on living annuities as a standalone subject this evening, but what you can do is you can go onto my YouTube channel, Freedom Financial Planning, and what you can find there is the living annuities presentation that I did. Also quite a bit of Q&A at the end, which I think was quite helpful. And so today we're going to be kicking on with life annuities and then coming back to how to combine them with living annuities. So firstly, just to recap, what is an annuity? This is a bit of a definition. An annuity is a life insurance product and it pays you an income at retirement. When it comes to pension fund rules or provident fund rules or retirement fund rules, you must use at least 2/3 of your pension fund, pension preservation fund, or retirement annuity fund to purchase an annuity, whether it is a living annuity or a life annuity. You get two types of annuities, as we talked about before, a life annuity and a living annuity. An easy way to remember this, a little rule of thumb, is that a life annuity secures you an income for life. You can also use it for a term, but either way, the income is guaranteed. So the word life annuity, income for life, it's kind of easy. Then you get a living annuity as a lump sum that is invested. And you can change your income every year between 2.5% to 17.5% withdrawal rate. And so the capital might run out one day and then your income will stop. And so there's no guarantees. It is not potentially for life. Hopefully it is, but there's no guarantee that it is for life. And so sometimes we refer to it as a living annuity because it's a living, breathing thing. The values change in the markets every day. Every year you have to go and maintain it by changing income levels and so on. So it's a living thing. And then a living annuity as well, you can leave any remaining capital to beneficiaries like children or a spouse as well. Now, let's focus on life annuities. Pays an income for life, a guaranteed income for life. It could be seen as a bit more of a boring option. But before we get into using it in retirement, just to let you know, there are actually two types of life annuities, just to add some further complication to life. The first one is the normal conventional option. It's bought with your retirement fund. But there is also one called a voluntary annuity. As the word says, it's voluntary, so you can decide to purchase this annuity and you buy it with discretionary capital. So discretionary capital, if you know the terminology for retirement funds, it's often called compulsory money or compulsory capital. The reason why it's compulsory is because it's within this regulated product and you kind of have to do what the laws tell you to do from then on out. Your money has to, 2/3 of it must be used to buy an annuity or a pension one day. It's a compulsory thing. So it's kind of like prescribed for you what you need to do. Discretionary means that you can do with it what you want. And so that is money that you have available to in your bank account or in unit trusts, any capital. And all of that money is after tax money, obviously. And so you can use that after tax money. If you've got like R1 million lying around and you want a guaranteed income at a nice rate, you can actually, instead of maybe buying a government bond or something like that, you can buy a voluntary annuity from a life insurer. It can be for life or it can be for a specific term. Now, a specific term might be, for instance, you just need income for 10 years, you've got a certain amount of money, and then you know something's going to happen thereafter, you don't need income anymore. This option might be suitable because annuity life companies, they prescribe a certain rate. And if the rates are favorable at the time, your starting income could be very generous, maybe better than you could get if you invest the money and withdraw an income. Another thing is that if it's over a term, well, not necessarily just over a term, but what they do is if you have this money paying out to you from discretionary money, not all of that income is taxable. Now, there is a formula that is utilized. I'm not going to get into it now. You guys don't need to prepare for exams or anything. But the thing is that there's a big chunk, most of the income should not really be taxable. And so when you receive the money back, only kind of the profit portion is taxable. And so if you had to get a quote for this from some insurance company, they would probably in the income tell you what the taxable portion is. Now, if you get income from interest-bearing investments like a retail savings bond or something like that, it's all taxable. Obviously, you get the annual allowance for interest every year. However, with this, only the profit portion is taxable. It will always be the smaller portion. And so it can be tax efficient in a way. Once again, if you don't want any volatility or you can't stomach any volatility in the markets, you just want a guaranteed pension. So let's get back to life annuities. And for this conversation, we're really just going to focus on the traditional kind, the one that you use retirement fund money for. In other words, the compulsory life annuity. So it really can be on your own life, a single life, or it can be on a joint life. In other words, with your spouse. So what this means is this. Say I now am retiring and I want to use some money to buy a life annuity. It can be on my life and it will pay me an income until the day that I die. But what if I am married and my wife is maybe a similar age and I take it out on both of our lives? And so what can happen then is if I pass away, it will still pay an income for as long as she is alive. So you can have it on a single life or a joint life. Furthermore, you can have an option where the income potentially reduces a bit upon the first dying spouse. So what that means in practice is if myself and my wife take this life annuity out and say I pass away at the age of, I don't know what, 85, for argument's sake, and she's still got a good few years in her. And then what we do is we say, fine, what the income may drops down by 25% if I die or when I die. So she gets 75% of the income. Now, there's two reasons you might want to consider that. Firstly, in practice, your level of income required generally does drop if there's one less mouth to feed. There's one less person on the medical aid. The groceries will reduce. There are a few other living expenses that will come down as well. And so you might not need all that income. It will be great, but you might not need it. Now, the reason why you might be willing to make this sort of trade-off or compromise is because if you determine to stagger the income amounts, if you look to reduce the income amount upon the first dying, say about 25% or whatever the case may be, the insurance company will give you a higher starting income. The reason why they do that is pretty simple. Is because there will be less capital that they need to keep aside to pay out salaries for the rest of your lives. So there are options. If you ever go into pursuing a life annuity, you can explore these options a bit further with the product provider or maybe your advisor as well. But there are ways and means to kind of squeeze out every cent of that annuity at the beginning of the relationship. And it's important to do so because once things are set up, they can't be undone again. Another thing to keep in mind is that you can have guarantee periods or minimum payment terms on a life annuity. So what this means is, and I think we've all heard the one concern that people have with life annuities. The concern is that I could, for instance, give 10 million Rand to an insurance company and tomorrow I get knocked over by a bus and my family gets nothing. I think I've actually heard those words before. And so to mitigate that risk of your capital just going to make shareholders of an insurance company rich, if you pass away early, what you can do is have a guarantee period. The longer the guarantee period, the slightly lower your starting income will be, because now there's a bit more risk for the life insurer. They have to make sure they got that obligation and liability to pay the income, even if you pass away. Now, let me explain this in practical terms. I could have a guarantee period of, say, 10 years. That means the insurer must pay an income for 10 years. Now, say I am 65 and the guarantee period will expire at 75. Now, say I'm around for 3 years. So now I'm 68 and something happens to me and I pass away. There are still 7 more years of that guarantee period left. So now what they will do is the insurance company will look at my beneficiaries. Let us assume I'm not married, but maybe I have a child. And I have the beneficiary listed as my child. And so what they'll do is they'll contact the child, and they often offer an option of either, do you want to receive that annuity income for the next 7 years for the balance of that period? It will just be an additional salary for that child for 7 years. It will form part of their taxable income for the year. Or they can be given the option with some providers where the insurer will add up the value of all of the future installments, the future salaries, and can pay it in a lump sum. So now the child can choose. Either way, tax will be applied. So if it's a lump sum and it's a fair amount, that'll be added to their tax for the year. They'll be taxed on that. It could be a bit hefty. And so what you might find is beneficiaries, they could use supplementary income for a while. It's kind of the last thing you can do for your children when it comes to a life annuity. Now, I did say earlier on that when you do things to these products, it can impact on the starting income. So if you have 0 guarantee period, then you will have a potentially higher income. And it won't be thousands more, but it could be hundreds more, quite a few hundred. And that makes a meaningful difference, especially for people who don't have a lot, for people who are cutting it fine. But you can think of over the years, if it's say 700 or 800 Rand a month more, multiply by 12, increasing every year with inflation or a set fixed rate, you can imagine how much money that equates to. So you could be leaving that on the table if you want a guaranteed period. And so once again, that's a conversation you need to have with your spouse, with your family, to determine if it's a worthwhile trade-off. So you heard me earlier on talk about rates. A life company applies a rate to you when you ask for a life annuity. What they're doing is they're looking at you as a risk. They're looking at how much capital you've got. They're looking at your age, your demographics. They utilize statistics. I think it's from Stats SA and whatever other sources I think they deem useful. And the actuaries every week will update rates that they apply for males and females at certain ages for certain life products. This is very heavily dependent, though, on bond yields. The yields, the returns, or the interest you earn on bonds. Okay. Now, a lot of us as retail investors, we think of bonds and we think of SA retail savings bonds. That's not necessarily what they're looking at. What they're looking at is the bond market. Now you get 20-year bonds and 30-year bonds and 10-year bonds, these very long-term bonds. Now, what a lot of companies do, and I'm not going to speak in too much detail on this because I'm not an actuary and I don't work for a life insurance company, just as a disclaimer. But what they'll do is they will look at the rates, the yields that these bonds are producing. And so they might buy bonds and match them with the liability. The liability is the salary they have to pay you as a client for the rest of your life. And so if you go to them and you're 75, maybe their mortality table says you have, statistically speaking, another 12 years. And so what they will do is they'll say, you want to give us 2 million rand. We think you have 12 years left. We can get these other yields on the bond market right now. And therefore, when all of these combine, we would give you X amount of thousands of rands a month for your annuity. And so it's a very competitive market. The life insurers all offer very similar annuities, not the same, but similar. But they all have slightly different ways of calculating what they would be willing to offer someone. I think it comes down to their analysis of data and their appetite for risk. Furthermore, you might have heard people talk about in the media that pensioners will be happy because bond yields are high right now. That doesn't, once again, necessarily relate to the yields you're getting on retail savings bonds or anything like that. The bond market is traded heavily, like shares on the JSE. And so when the interest rate changes, it impacts the long-term yield curve of the bond market. Now, once again, I'm just to warn you, I'm not going to get into extreme detail here because I'm going to make a fool of myself. But think of it this way. At the moment, the interest rate is high. So any new bond that rolls off the floor, so to speak, that is produced and is priced, it's priced at an interest rate that is kind of happening right now. So they're promising whatever, if they're offering 10.25 or 11% on a 10-year bond or whatever, they're offering that right now because the interest rate is high. The interest rate is over 8%. Now imagine the interest rate goes down. Tomorrow, the next 10-year bond is issued at a lower interest rate. So now you probably want to get your hands on the older bond that is, still at a higher interest rate. And so then what happens is there comes this competition. People are trading. And so what maybe a good thing to consider is my observations have been that when the interest rate goes down, yields might increase. And that might help long-term bond investors, people who are very long on government bonds and other sorts of instruments. But also, if you're looking to apply for a life annuity at that time, you might be able to ride a wave. Now, that happened during COVID. Okay. So during COVID, the interest rates were slashed, right? They were almost halved. It seems like a lifetime ago now, but they were almost halved. And so what happened was the interest rate was still, historically there were bonds out there priced on the old interest rate. And so those became very generous. So people were buying it at a premium and people were selling it at a profit on the bond markets. And so what happened there was people that were retiring at the time and they were using life annuities, they were getting these amazing deals. So the annuity rate that is offered, it's a complex thing. It changes weekly. Every Monday, they are published again by the providers. So it's a guaranteed income for life, but you want the income to increase unless you don't think you're going to live long or you think there's going to be no inflation. So what's going to have to happen is you're going to choose, how do I want it to increase? Do I want to increase by a fixed percentage, like 5%, 6%, 7% a year? Or do I want it to be like floating increases that are linked to inflation? So if for instance, say March is my anniversary year of my life annuity, it can go up by the rate that I chose years ago when I retired with my life annuity. So it might be 5%, and maybe I'm happy with that. Long-term average of inflation in South Africa is around about 5%. I think, 0.1% either way. So you probably might be fine there. However, some people might have chosen inflation. So inflation during COVID was low, and so people who got their annual increases then got like a 2.2% increase or something. People with a CPI inflation-linked increase to their income would have last year got some nice increases because it would have been about 6% or so. Now we're down to the high 4s, low 5s, depending on the month. And so it will always be up and down, but it will be an accurate reflection of the consumer price index in South Africa at the time. Now, something to bear in mind is that The higher the guaranteed increase that you want, the lower the starting income. Obviously, the insurer has to make money. And so what they're going to do is protect themselves and say, well, if you want a 7% or 8% annual increase, we're going to give you a lower starting salary. And it will be a few $100 lower than the next increment. So with clients, what we have done is we'll often do quotes where it's like a 5%, 6%, or 7% increase and an inflation increase. And we kind of create a grid, a table with all of the different product providers, and then we can start comparing apples with apples. Okay, there's something called a with-profit annuities or investment-linked annuities. In a nutshell, these annual increases in your salary with these annuities depends on the performance of an underlying investment fund that you chose. Okay, so this is still a life annuity. It's not a living annuity now. Your income is guaranteed for the rest of your life. But what they're telling you is, look here, you choose, pick a horse in the race, put all your money on it, and if it does well, you get nice increases every year. And if it does poorly, you don't get nice increases every year. It gets very technical. A lot of the providers will look at the last, I think it's the average of the last, say, 6 years of returns for a particular fund. And it often comes down to just one fund. I think there's 1 or 2 providers where you can blend the funds. You can have 3 to 4 funds, and then you allocate, like say, 25% to each. And then what they do is they average out those funds returns over the period looking back. And they say, okay, it did say 10% on average a year for the last 5 or 6 years. You had to clear a certain participation rate or a hurdle rate. Maybe it was 2 or 3%. And then you get 75% of anything above that. So if it was 10% and you clear a hurdle rate of say 2.5%, then you got 7.5% left, and then 75% of that is something, and that will be your annual increase for the year. And it does that every year, looking back a rolling 6 years. Now, it can be attractive, especially if the fund you've chosen is doing extremely well. You've been in a long bull market. You're very confident of that fund's pedigree and how it's going to do into the future. But the challenge is, well, there are a few challenges with that. Firstly, there's no guaranteed increase. So you could have a year or two where you don't have any real increase in your income, and that can be problematic. Secondly, you're going to be, once again, watching investments. You're going to be watching investments, and you're not even invested in the funds, but you're going to be watching them to see what your potential increase might be in the time to come. Thirdly, when you pick one investment fund, what's going to have to happen is you're going to have to hope that fund is not too style biased. What I mean by that is you get some funds that have a more of a value investment style orientation. Some have a more quality, some have a growth. All of these styles are favored by the market at any point in time, or rather they are rewarded by the market at any point in time, sometimes at the same time, but generally speaking, they all have their moments. They're cyclical. And so you might be dependent on a style being favored for you to be able to get some sort of investment return, or annual increase rather. You see, it forces you to talk about investments when what you've done is not invest your money. So I don't necessarily promote this option too much with clients. There are 3 reasons. Firstly, you lose a bit of control of what might happen in the future with your income. Secondly, it's complicated. Another thing, though, is that the underlying funds they choose, they're Regulation 28 compliant funds. And so you're always going to get very nominal returns, like inflation plus 4 to 5. You can't, unfortunately, have it in a world index tracker, for example. And so it limits your options. Therefore, I generally do not provide this option, or I do provide it to clients. We talk about it, but we generally do not pursue it much. So a blended annuity is when you have a living annuity And then inside the living annuity, you use some of that living annuity money to buy a life annuity. Okay. Now, this is the bullet point above. It's a mixture of that. What I mean by that is, let's just imagine you've got a 10 million Rand living annuity. Let us say you use half of it for the sake of maths. So 5 million Rand you use to buy a life annuity, guaranteed income for life. But you still must pick a horse. You must still pick a fund. And that fund will determine the increase in salary you get from that portion of your living annuity. Okay. So once again, it's a bit tricky to manage. When it comes to the blended annuity or the with profit annuity or the investment linked annuity, any of those annuities where the future increases are linked to an unknown, which is an investment return. Not even the insurance company knows what your increases might be. So they can't overcommit on the starting salary they give you. Because if they do, then for the rest of your life, they're going to be, in the red because they have been too generous. So what we tend to find is the starting salaries that they give you in retirement with profit annuities or investment linked annuities and blended annuities are the same because it's a with profit within a living annuity. We tend to find that the starting salaries are not very good. So it's almost better to rather have a life annuity and a living annuity. Now, it can work for some people, especially when they don't necessarily need that income now. They don't need a lot of it, but they just want the peace of mind knowing that a portion of their retirement savings are always there to provide an income for them. But at the end of the day, a lot of South Africans are in a situation where we want to get the most out of every cent we have. And so the blended annuities don't offer the best starting salaries up front. Once again, it mightn't be ideal for some, but I tend to find for most, it becomes a very complicated, a complex discussion, and the lack of certainty is a drawback. So, what are the pros and the cons of life annuities? Firstly, with a life annuity, your income is guaranteed for life. That is amazing, and that's the main reason why it exists. You can have guaranteed income increases. So if you pick inflation-linked increases or a fixed rate, you will get those increases the rest of your life. There's no investment risk, obviously. And so this will give you peace of mind, especially if you are quite nervous about your finances, and especially if you don't have enough. What I mean by when you don't have enough is if things are going to be tight going into retirement and you need to make every cent work for you, it might not be good to leave that up to the fate of the markets. It might be better to err on the side of caution and lock in what you can, control what you can from the outset. So the drawbacks, as I said before, there are no more capital options with your money once you purchase a life annuity. It is a dead end. It is the end of the road. That money is no longer yours. You undoubtedly have a right to the income, but that capital is gone. So you can't go and withdraw, 30,000 Rand because you want to go to, Club Mykonos for the weekend or something like that. No legacy is available for beneficiaries, children, spouse, if you don't have it on both of your lives. Another thing is that it's just rigid. It's set in stone. And so you have to be on board with the decisions you make about this annuity up front, because it could be a case of, if you pick a low annual escalation, like 4% or something ridiculous like that, and inflation tends to be a lot higher, you can't go back in time and increase your salary. And so there's that lack of ability to change anything. Inflation risk is a valid concern. Another thing is that you do rely on the solvency of the life insurer to provide you with an income for the rest of your life. You've given them your millions, potentially, or hundreds of thousands, or whatever the value was of that annuity, and you have put faith in them to pay you an income for the rest of your life. So who is the ideal client for the life annuity? Firstly, if a person does not have enough, if we know that you don't have enough in retirement, like about 94 to 95% of South Africans, then it might be a good option to incorporate this into your plan. I'll give you an example just now. I'll show you a case study as to why that is the case. But if, for instance, you know you've always needed an income of 30,000 a month after tax to retire, and you know the best an investment can do, a living annuity can do without completely depleting it, is maybe 24 a month or 25 a month. A life annuity might be able to do a bit more because the yields are higher at the moment, so maybe between 25 and 30,000 a month. It might be worthwhile considering and locking in that advantage and guaranteeing it for the rest of your life, because nothing is guaranteed when you invest in a living annuity. No one can tell you there's guarantees there, but we do know contractually and otherwise that the life company has an obligation to pay you for as long as you're alive. And so if you look at kind of mitigating risk, the biggest risk is running out of money. And this, by buying a life annuity, you know that you will at least always have an income. And then if that's your only option and you have to resort to that, then you know how long the piece of string is, and you can try and make do with that in your life. Another thing is if you are risk averse. So I had a client it was actually during COVID. She retired and she was fine for retirement. She had enough. Her husband was retired already. The last thing she wanted was statements every quarter to know what her investment's doing. The last thing she wanted was to review it. She wanted a pension. That's what she wanted. She was risk averse. She wanted to mitigate risk within her household. Perfectly fine. So we had the conversation, talked about the pros and cons of both life and living annuities, and she chose a life annuity. And peace of mind. Peace of mind is something that a lot of money can often not buy. And so if you have your main living costs covered by a life annuity for the rest of your life, I mean, your primary living costs, like your medical aid, your rates, groceries, if you know that is covered for the rest of your life with a life annuity, you can just breathe a little bit easier. The rest of the money, maybe it's invested in a living annuity or in other investments, that you have to keep a close eye on, but at least you know that your basics are covered. And that provides a peace of mind, which, as I said, can be invaluable. Okay, so let me quickly take you through a short case study where we've in the past combined life and living annuities for a client. Bit of background, the retiring couple were 65 at the time. Both of them retired within a couple of months of each other. If we invested their capital in a living annuity, the withdrawal rate would need to have been 8.5% per annum at retirement to meet their needs. Okay, so this is a very high withdrawal rate. We want to start maybe, 5-ish around there at retirement, lower if possible, but a lot of South Africans can't afford that. So at 8.5% per annum at 65, it's a guaranteed failure. The capital will be eroded and they will have nothing left. I think it was something like within just over a decade, 14 years. So financial modeling showed the liquidity crunch would come into their estate at 79. By liquidity crunch, what I mean is that they wouldn't be able to afford their monthly expenses by the age of 79, considering all of their assets in their estate based on an 8.5% withdrawal rate from a living annuity. So what we did was we ran various scenarios where we took a portion of their retirement fund and we used this portion to purchase a life annuity. So what we do is we get life annuity quotes and we work out how much per million they will get per month. And then what we do is we run various scenarios. If it's 20%, 30%, 40%, 50%, 60%, we try and find a point where people are comfortable, the client is comfortable with how much they're giving to a life insurer versus how much they have left in a living annuity. At the end of the day, though, the financial plan will kind of tell us what the sweet spot is. So the outcome, and this is a real life outcome, 40% was used for a life annuity, and then 60% was used for a living annuity. So this couple, at the beginning, they said they don't want anything in a life annuity because what if I die from something, within the first year or two and my kids get nothing? It's an age-old argument, but we looked at the longevity of the capital and we had to make some sort of trade-off and compromise. So 40% is the highest they would go. So the life annuity income started off at 6% per annum, and it was on a joint life annuity with 5% per year guarantee term and a 75% survivor income. So what this means is that the joint life with 5-year guarantee, it was on both the husband and wife's lives. So it'll carry on paying a salary until the last of the married couple passes away. There was a short 5-year guarantee term. They are planning to travel to a few places, or they had planned to travel to a few places early in the retirement. And they said if they pass away while traveling on a car accident or a plane crash, they want their children to get the rest of the income for the balance of the guarantee period. So we took a 5-year period. 75% survivor income means that the income would reduce by 25% once upon the first dying spouse. So the passing. So the husband passed away first, for example, the wife would get 75% of the income. The income from the life annuities was sufficient to cover the couple's medical aid, their medicines, their groceries, electricity rates, and water for the rest of their life. Okay. No entertainment, no travel, no purchasing of cars, nothing like that. But those are the basics. And now they know that for the rest of their lives, that should be covered sufficiently by the life annuity. And they are now withdrawing 6% from their living annuity instead of 8.5% per annum. So you can see it was a healthy compromise for them, but they had to make the decision to pay a life company for an income for life. And what that did was it added potentially another 10 years of longevity to their capital. So initially, the financial planning modeling showed that at the age of 79, they wouldn't have enough money for their expenses. Now it was showing a scenario where by about 89, it would become tight. And so that is a real outcome with real people. And it just shows you how you can use the various options available in the market. So just a few tips before I close off. This is my last slide. You can buy a life annuity with a living annuity, okay? But you can't go the other way around. I mentioned before that a life annuity is a dead end. It's the end of the road. That money is now gone for the rest of your life. And so you can, however, utilize a living annuity one day to purchase that life annuity. Annuity or income rates get better the older you are. This is a bit of a no-brainer when you realize that the insurance company is trying to work out how long you might live for. And so if you're 80 and you want the safety blanket of a life annuity, the rate you will get will be much better than yourself when you were at 65 years of age. So what you might want to do, or an option you can consider, and once again, this is not advice, it's just a tip, is if you're unsure, you can start off with a living annuity, and then later in life, you can always use that to buy a life annuity from a life insurance company. However, you can't use a bit of a living annuity to buy a life annuity. If you have, for instance, 5 million Rand in a living annuity in one contract at one company, one provider, you can't use a bit of that to buy a life annuity. What you then have to do is you have to use all of it. It's per contract. So if one living annuity is one contract, you have to use all of that. So it's kind of like when you play at the poker table and you go all in. It is all in. And so what I suggest to people, and something we do with our clients, is at retirement, create at least 2 living annuities. So say you've got a big company pension fund, most of your money is there. You can go to one company and like an investment platform and set up a living annuity, but then your money will always pretty much be locked up in that one living annuity. Or you can kind of go like 50-50 or whatever ratio you want and get 2 living annuities, 2 separate contracts. It can be with the same provider, but it must be a different contract. And so when you have these 2 contracts, you have options. You don't have to go all in to buy a life annuity one day. You can say, okay, I'm ready. I want to buy one if you need to. And then you can use some of that. Cool. I hope you guys enjoyed this, and thanks very much.